Welcome back to the Deep Dive. Today we're digging into MindWalk Holdings, NASDAQ ticker HYFT, and their latest earnings call is, it's a big one.
It's a really big one. This isn't just about the numbers. MindWalk, which, they used to be immunoprecise antibodies, is in the middle of this massive pivot.
A huge pivot. They're moving from a traditional services company to what they're calling a pure TechBio platform.
Exactly. It's all centered on this new bio-native AI architecture. And this quarter was basically their proof that the whole strategy is working.
Okay, so let's jump right into those proof points. The top line numbers, and we should say this is for continuing operations, so it excludes that Netherlands lab they just sold.
Right. We'll get to that divestiture in a minute.
So headline revenue, $4.1 million Canadian.
And that number represents 54% year-over-year growth.
54%. And 30% just from the last quarter. Management made a point of saying this was a record for their core business.
But the revenue, as good as it is, that's not even the most interesting part of the story. You have to look a little further down the P&L. Gross profit. It nearly doubled.
It jumped 94% year over year to $2.7 million.
Which brings us to the really remarkable number.
The gross margin. It expanded to 65% for the quarter.
65%. And you said that's a huge jump. Up from 51% last year. That's a 1,400 basis point expansion.
14 full percentage points in a single year. And they finished the quarter with, $16.5 million in cash?
Yep, $16.5 million. Yeah. So look, when a company does this, when they shed the low margin stuff and go all in on a tech platform, you expect margins to get better. But 65%, that's an aggressive leap.
It really is. I want to stick with that 65% margin for a second because in biotech discovery, you just don't see that. That's a SaaS company margin, not a therapeutic platform. How did they actually do it? What drove that massive expansion so fast?
It was a couple of things coming together perfectly, which the CFO laid out pretty clearly. First is just operating leverage. So they've already built the infrastructure, right? The servers, the patents, the core team, those are fixed costs. But now the projects they're running are getting bigger and much more valuable.
So more revenue is flowing over the same fixed cost base.
Exactly. The operating costs aren't really growing in proportion to the revenue from these huge new programs.
So they bought the kitchen, and now they're cooking Michelin star meals instead of diner food.
That's a perfect analogy.
Yeah.
And the second part is the project mix itself. They are deliberately taking on work that uses the AI platform more and uses the traditional lower margin lab work less.
So every new dollar of revenue is just better quality, higher margin.
It's a much higher quality dollar.
The big question then is this sustainable? Is mid-60s the new normal for them, or was this just a one-off great quarter?
Management sounded very confident. They said they're happy with the mid-60s, but they actually expect margins to increase more over the next 9 to 18 months. They see this as the new floor, not the ceiling.
Wow. Okay, and a big part of that strategic shift was a major move on the balance sheet this quarter, the divestiture. Let's talk about selling off that wet lab in the Netherlands.
That was a critical move.
Yeah.
It generated about $14.3 million in net cash.
Right.
But more importantly, it got rid of a capital-intensive, non-core part of the business. That lab just didn't fit with the new AI-first strategy.
I have to ask the skeptical question here, though. In this space, especially with AI, data is everything. Aren't you worried that by selling a lab, they're cutting off a source of proprietary, real-world data to train their models?
That's a very fair point, but they were pretty clear about which lab they sold. It was focused on services, not the kind of unique data generation that actually fuels the bio-native AI. So this is more about removing drag than it was about removing fuel.
Got it. So they get a stronger balance sheet, more cash, and more focus.
Exactly. Which means everything now rides on the strength of that proprietary tech.
So let's get into it. What is this core asset, this bio-native AI?
Okay, so the foundation of the whole thing is what they call HYFT patterns. And the key phrase here is they are patented immutable subsequence codes.
Immutable subsequence codes. Okay, let's break that down for everyone. What does that actually mean?
Think of it this way. The whole universe of biological data, all the DNA, all the proteins, it's like a massive, noisy library with billions and billions of books.
Okay.
Most AI in this space tries to read every single word in every single book to find something interesting. It's just brute force.
Which sounds computationally exhausting and expensive.
It is. MindWalk's claim is that their HIT patterns are like the unique ISBN codes on the back of the book, or maybe the key chapter titles. They're the core unchangeable parts that actually define what the book is about.
So they're not reading the whole library, they're just scanning for the ISBNs.
That's it. They focus all their computation only on these very specific conserved patterns that they know carry biological meaning. They just cut through all the noise.
And that precision, that's what ties back to the 65% gross margin.
Yeah.
You find the answer faster, you waste less time and money in the lab.
Precisely. The technical advantage drives the financial results.
Okay, this is where it gets really interesting for me. They're not just talking about the platform, they're using it to generate their own internal assets. And the data they shared is pretty impressive.
Yeah, they highlighted two big programs. The first one is in the GLP-1 space.
So we're talking about the science behind drugs like Ozempic and Wegovy, the hottest area in pharma right now.
The very same. They use their platform, Lens AI, to design new GLP-1 receptor agonists. And the results, which were validated by a third party.
So not just their own internal data.
No, independently validated in vitro assays. Their designs achieved receptor activation above semaglutide.
Above the current market leader. Now, it's early, it's in vitro, but still, that's a huge validation for the platform.
It's a massive proof point. And they also stress that the AI didn't give them 1,000 maybes. It gave them either a single best design or a very, very short list that shows a ton of confidence.
And what was the second program they talked about?
The Dengue Vaccine initiative. Dengue is notoriously difficult because you have 4 different stereotypes, and a bad vaccine can actually make a subsequent infection worse.
Right, the antibody-dependent enhancement problem. It's a huge hurdle.
A huge, dangerous hurdle. So they used Lens AI to find a conserved biochemical pattern that exists across all 4 dengue types, and one that's also very different from human patterns.
So the goal is to get a safe, effective response against all 4 at once.
Exactly. Again, using precision pattern recognition to solve a really complex biological problem.
But developing assets like this, especially a GLP-1, is incredibly expensive. Which brings us to what might be the strategic masterpiece here. How are they going to fund this without burning through their cash or just constantly diluting shareholders?
This, for me, was the single most important innovation they talked about. It addresses the biggest problem for almost every TechBio company. They're setting up a Cayman Islands-based segregated portfolio structure, an SP.
A segregated portfolio. Okay, that sounds complicated. Why go through all that trouble? Why not just raise money the old-fashioned way?
Because it's designed to protect the parent company. So think of MindWalk Holdings as the factory that owns the AI platform.
Okay, they own the blueprints.
Right. And each asset they create, like the GLP-1 program, gets put into its own legally separate company, its own SP. So the GLP-1 asset goes into, let's call it SP Alpha.
I see. So you can invest just in that one program.
That's it. An investor who only cares about metabolic diseases can put money directly into SP Alpha, and that money is ring-fenced just for that program. The parent company, MindWalk, keeps the core IP, and its own stock is not diluted at all.
That is genuinely clever. It lets them move multiple high-cost programs forward at the same time without crushing the parent company's stock.
And management confirmed they are already in active discussions with investors about this. It's not just a theory.
And to execute all this, they've brought in some new leadership, a new CFO, Scott Ericato, and a new chief business officer, Dr. Thomas Lynch. What's his main job?
Dr. Lynch's job is all about scaling the commercial side. So while the SP structure handles the internal drug pipeline, they also want to sell access to the platform as a software as a service, a SaaS model.
Ah, so it's a two-pronged strategy. Create their own assets funded by SPs and license the platform to others.
Exactly. He's there to build out the sales team and really drive that SaaS business.
And all this ties into their capital planning. They filed for a $30 million ATM facility, an at-the-market offering.
They did, but they were very clear about it. They see that ATM as a backup, a safety net for the future. The priority right now is this non-dilutive funding through the SP structure.
So with all this change, the new structure, the new people, the new data, what is the single biggest catalyst we should be watching for?
They gave us a very specific deadline. They intend to share a formal update on the SP structure, more data on the lead programs like GLP-1, and their whole capital strategy. Before the market opens on the first day of the JP Morgan Healthcare Conference.
Wow, so they're setting up a major announcement right before the biggest biotech conference of the year. That is a high-stakes move.
It's designed to frame the entire story for every investor and potential partner descending on San Francisco.
All right, let's shift gears. It is time for our mandatory segment.
This is not financial advice.
We are synthesizers of information. We are not licensed advisors. Do your own research. Do not trade based on our discussion.
Okay, disclaimer done. So if we were building an aggressive, Outrageous but plausible trade idea here.
It has to be built around that JPM catalyst timing.
Absolutely. The play is simple. Go long MindWalk, HYFT, specifically as a bet on that pre-JPM announcement. It's a timing trade, not a long-term valuation call.
And what's the logic? What would drive the move?
It's two things hitting at once. First, the market finally gets clarity on the SP structure and hopefully values the non-dilutive aspect of it. But the real hook is the data. If they come out and firmly detail that their GLP-1 asset is superior to semaglutide in these assays,
And you combine that with a non-dilutive way to fund it.
the market could re-rate the stock and re-rate it very quickly. The trade is that you see a big spike on that news release before the conference even really gets going.
And the risk to that trade.
The risk is purely logistical. Some legal or regulatory snag prevents them from making the announcement on time. If they have to push it, the catalyst evaporates and the momentum cools off.
A fascinating high-stakes play. It really does capture everything they're trying to do right now. So, to recap our deep dive on MindWalk Holdings. This quarter was a massive validation of their pivot. We saw record revenue for the core business, up 54% year over year.
And that incredible, and they say sustainable, 65% gross margin.
Which is all being driven by the precision of their patented HIT pattern, Bionative AI platform.
And now they have this really clear two-track strategy. Internal assets, like that very promising GLP-1 program, funded non-dilutively through the SB structure, and then the external SaaS model being scaled by the new CBO.
This whole structural shift, separating the platform from the assets, is a really big deal. It could change how a lot of companies in this space think about funding and risk. Which brings us to the final thought for you to explore.
In a world where biotech capital is getting harder to come by, does this segregated portfolio model become the new gold standard? Is this the framework that everyone else starts to copy to fund their expensive AI-driven drug programs?
That structural precedent could end up being their most valuable asset of all. On that thought, we will see you on the next deep dive.